The Fed is engineering a recession and they won't stop until they get one. Hey everybody, Dr. Richard Smith here, aka the Doctor of Uncertainty, and we are back with another episode of Market Moves. It's been a while since we got together, and hasn't been any shortage of things happening in the markets, so let's get right into it. First, just want to talk about the big picture. The big picture is that we continue to be in the midst of crises. There's the big crises and there's the near-term crises. Yes, they're connected, but we do have to be careful to distinguish between them too, because I don't think that, the end is nigh, but I do think that over the next 10 years or so, we're in for more trouble than we're planning for. So let's take a look just at the crisis du jour, which is that we've got an economy that's too hot, inflation isn't under control, and the Fed is engineering a recession and they won't stop until they get one. So we looked at this chart in one of my past writings recently, and this is showing what happens to the stock market during recessions, right? All these gray bars are recessions, and we always see declines in the markets. And we know that we've got this great recession predictor, which is the difference in the yield or the rate of return between the 10-year treasuries and the 3-month treasuries. Every time, the economy's gotten too hot and the Fed starts to put the squeeze on, we go from about a distance of about 4 percentage points, right? And then we start to normalize. And as we start to normalize, we get a recession. Okay. Same thing here. From the peak down to the bottom, about 4 percentage points. Start to normalize, get a recession. Peak, bottom, about 4 percentage points. Start to normalize, get a recession. Peak, bottom, 4 percentage points. Start to normalize, get a short recession. Peak at 2% now, not back at 4%, right? But at 2%, bottom, starting to normalize, recession is coming, okay? So let's zoom in here just a little bit and look at what's been happening in this chart just over the last few months. So it's starting to go up and it's continuing to go up over the past month since we last talked. What's happening is that the 10-year rates are going up faster than the 3-month rates. So we're starting to normalize. You want to get paid more for longer term loans, right? And right now we're in this inverted environment where you're getting paid more interest for shorter term loans and less for longer term loans. But now that's starting to normalize and it's continuing to go up. And we see that when that happens, that's when the recession hits, okay? And just going back to the stock market again, there is no soft landing ahead. Every time a recession happens, we get corrections in the market, okay? So I'm planning on a correction. We're in the middle of a correction. Don't know how low it's going to go, but we're definitely in the middle of a correction and it's not over. One more look at what a yield curve is. So this is going back to March of this year, June of this year, and today. The blue line is today. The gold line is where we were back in March. These are different maturity lengths over here. So 3 months is right here, and 10 years is right here, right? So back in March, we were getting almost 5% on a 3-month treasury bill, and we were getting about 3.5% on a 10-year. Today, we're getting 4.25, 4.7. I think it's even higher today, maybe over 5 on the 10-year, right? And the 3 months have gone up a bit, but not nearly as much as the 10s have gone up. We see this curve beginning to flatten, right? A normal treasury curve is going up from left to right. You're getting paid less interest for shorter term loans and more interest for longer term loans. We've been in this inverted environment now for quite a while, but it's starting to normalize. And again, I just make that point over and over again. One, so you understand what a yield curve is and what yields are and what is normal, but also to know that this is the most powerful indicator of recession that we've got, and it's flashing. Recession is coming. So that is the short-term crisis. Getting back to the longer term picture, right? This is a chart I've been showing regularly now for a couple of years. Interest rates on 10 years peaking at about 16% in 1983, coming way down into 2020 and rising back up today. Now they're up around 5%, so somewhere around here. This is the sea change in our economy that we're still coming to terms with and that we're going to be coming to terms with for at least another decade. We're back up to about where the long-term average is now, but because we came down so low here, this is like a beach ball going under the water that is popping back up above the water. It's got to pop back up higher, than you'd expect because it was pushed way down below. Getting back to the longer term crisis, we've got what Ray Dalio calls monetary policy 3, where the government is shoving money to the private sector, right? The public, that's us. A little confusing. The government is the public sector and we are the private sector, but we're also the public. So the government, through printing money, has been shoving money into the economy, way off trend, right? And this incredible excess of printed money is what's keeping the economy alive right now, but it's not sustainable. It will go away and it will likely move below trend before all is said and done. We've also talked about Peter Turchin and his end times thesis that right now we have declining population well-being in the United States and growing popular discontent. Life expectancy in the United States has dropped significantly for the first time in 100 years. We have elite overproduction and intra-elite competition and conflict. Everybody's gone to college to try to get out of the trap of the lower and middle class. And now we're all competing for fewer seats at the elite table. So I wrote a piece about this a couple weeks ago. I'm going to be following up on this. This chart just devastates me. Let's look back here in 1989 Q3. In 1989 Q3, we had the top 0.1% of the population in the United States controlling about 8.6% of the wealth in the country. The remaining top 1%, okay, had another 13.9% of the wealth in the country. So that's, what is that, 22.5% in the top 1%. That's these two green bands here. Let's go over to the latest data, which was Q1 2023. Now we see that the top 1% controls 31.2% of the wealth. And just the top 0.1% alone has gone from 8.6 to 12.7. That's almost a 50% increase in their wealth. Okay. These green lines are just the top 1%. That's not the top 10%. It's just the top 1%. So if we look at the blue sections here, we've got the remainder of the top 10% is this light blue line. This darker blue line is the 50 to 90%, and this yellow line is the bottom 50%. The bottom 50% of the population in the United States controls less than 3%, 2.5% of the wealth in the country, half the country, okay? And if you just take the blue line, blue section, dark blue section here, right? That plus the yellow is 90% of the country. 90% of the country only controls 31% of the wealth. The top 10% controls 69. and the top 1% controls 31, and the top 0.1% controls almost 13%. That's the situation we're in today in the United States. This is not sustainable. And, we recently saw that OpenAI seeks new valuation of up to $90 billion in sale of existing shares. OpenAI has 1,000 employees, maybe plus or minus a couple hundred, okay? Maybe 1,200. Still, 1,200 people representing a business today valued at $90 billion. Does anybody think this wealth gap is getting any less with the advent of AI? 1,000 people, $90 billion. This isn't even a publicly traded company, right? These are private sales of existing shares. This is a continuation of the wealth gap getting out of control, not getting any better, and it's only heading in one direction, and it's not sustainable. So again, this is going to lead to a crisis. We are in the midst of that crisis, and it's got a ways to play out before all is said and done. Moving on from the big picture, let's zoom in just a little bit to what's happening in markets today. Before we get into the details, I just want to remind us, even though I'm saying we're in the midst of a crisis, and we are, and it's a long-term crisis, and there is a recession coming, I still believe this 18-year economic cycle is playing out, and the next top 18 years is 2025, 2026. So even though I expect some short-term pain, I expect we'll be at new highs before we get the more significant correction. New highs might be sometime toward the end of next year, might be in 2025. I don't know. But I don't think the final top is in. I do think we're in for some shorter term pain. We're in the midst of that. It's not over. And then the rest of the crisis starts to really play out. So where are we today? This is from Bloomberg. Financial conditions are finally restrictive. This was a headline from John Authors, one of my favorite writers over at Bloomberg. What are we looking at here? This is, black line is the 10-year real yield, okay? This is what you really earn after inflation from a 10-year bond, okay? These blue lines here are what are called the 10-year break-evens. So this is the 10-year yield, the yield on the 10-year, right? It's about almost 5 right now, minus the yield on the inflation-protected 10-year securities, okay? Treasuries. So I know that's kind of hard to wrap our minds around, but the real yield right now, paid on the 10-year TIPS, the inflation-protected treasuries, okay, is about 2.5%, 2.3%. And the break-evens, which are the actual yields on the 10 years minus the yields on the TIPS, are also at about 2.5%. So this is an indication that financial conditions are biting, right? They weren't biting all this time back here. We had real yields lower than they should have been based on the break-evens. So I know that's kind of not easy to understand. It takes a little time to think about. It's worth thinking about. It really is. It's worth understanding because this is a very important factor in the market. So we've got these restrictive financial conditions now. It's hard to borrow money. Yields are going way up. Corporations, governments are having to pay more to carry their debt. And these are the times that we often see something break. We're in tighter financial conditions than we were back in the early part of this year when Silicon Valley Bank and others got in trouble. I said at the beginning, the Fed is engineering a recession until they get one. That happens typically when something breaks, and conditions are tighter right now than they were back in the spring. And I fully expect something will break. And I don't know when it's going to happen. I don't know how extreme it will be, but we're in restrictive conditions, and we need to understand that. Here again are the real yields on the 10-year. currently about 2.3%. I was watching Bloomberg this morning, and they were agog at real yields of 2.3%. This is historically not that high, but this move from down near 1% up to 2.3%, over 100% gain, is an eye popper. It's not supposed to move this fast, but it is. Again, the beach ball underwater, coming back up, popping above the surface faster than anybody thinks. We're also nearing the October, what do you call it? October Halloween. This is a little picture from John Authors again, showing different kind of sectors bottoming in October of 2022. That's what this black line is here, October of 2022, when everybody thought the bottom was in. And then we've had these sharp up moves since then in almost all these asset classes, right? Now everything's coming down again, okay, except for the Magnificent Seven tech stocks. So are we going to have another October bottom? This is a seasonal chart of volatility. Okay. We see over the last 20 years, volatility peaks in March and it peaks in October. Here we are, folks, heading into October. It's the end of September. We're heading into October. Volatility is peaking. Volatility hasn't peaked yet, more than likely. It's not even that high right now. But we can expect volatility to expand, especially if we get a government shutdown. That might even push expanding volatility out into late October, November. But expect volatility to expand, right? And what's happening? Everything's falling again. Stocks are falling and bonds are falling. This is the famous 60-40 portfolio. Both bonds and stocks are falling. The trend is down. It's below its 200-day moving average now. We had a relief rally this week. I don't think it's over, this correction. I don't know how long it's going to go. I don't know if something's going to break and we're going to have a 1987 style, crash and recovery. I don't know. What I do know is that conditions are restrictive. We're heading into October, which is one of the most volatile months. The trends are down, and the Fed is engineering a recession. They haven't gotten it yet. They're not going to stop until they do. Bond default rates are rising. Clear cyclical pattern here, right? Leading into the recession, through the recessions. And now the default rates are rising again. Just another indication of where we are in this cycle. So that's a picture overall of where we're at in the short-term crisis, in the longer-term crisis, where we're at in markets today. Don't have time to get into it today, but I want to talk more about portfolio construction and management. And I just wanted to share with you, to whet your appetite a little bit, this one chart that on our theme of rebuilding the real world. I just love this chart. Mid and small cap industrial stocks have outperformed ARK, Cathie Wood's ARK, since its inception. Okay, going back to 2015. Look at this boom and bust in ARK, and look at this steady climb of mid and small cap industrial stocks continuing to climb. I don't know who's going to win this race, but I'm betting on rebuilding the real world. Found some great asset managers that I'm going to talk with you in more detail about, that we can source our stock ideas from. And my Finiac platform is coming along amazingly well. Really excited about the new features we're developing, and I'm going to share more with you about that next time. So stick around. See you in a couple of weeks. Careful out there in these markets. Watch out for the October scare, and stay calm and cool. Talk soon.